Have you ever wondered how interest rates work or what they really are? Well, let's dive into the world of finance and unravel the mystery of interest rates. Before moving forward, if you're new to our channel, don't forget to like and subscribe to our channel for future interesting videos. Interest rates, in the simplest terms, are the cost of borrowing money. Picture it as a rental fee. When you borrow money, you're essentially renting someone else's money for a period of time, and the interest rate is the rent you pay for that privilege. Now, this rental fee is expressed as a percentage of the loan, and it's what borrowers pay to lenders over and above the actual amount borrowed. It's a bit like when you rent a house. You pay a monthly fee on top of the deposit you put down. Only in this case, the house is the loan and the rent is the interest rate. Now, why should you care about interest rates? Well, they affect the cost of everything you borrow, from the mortgage on your home to the credit card in your wallet. For example, if you take out a $100,000 mortgage with an interest rate of 5%, you'll end up paying an extra $5,000 a year just for the privilege of borrowing that money. And it's not just about borrowing. Interest rates also affect how much you earn on your savings. If you've got money in a savings account, the bank pays you an interest rate as a thank you for letting them use your money. The higher the interest rate, the more money you make. But remember, interest rates can change. They can go up, making it more expensive to borrow and more profitable to save. Or they can go down, making it cheaper to borrow but less profitable to save. So you see, understanding interest rates is crucial in making informed financial decisions. Whether you're thinking about buying a house, taking out a loan, or just saving money, the interest rate is a key factor to consider. When you understand how interest rates work, you can make better financial decisions. And that, my friends, is the power of understanding interest rates. Interest rates didn't just appear out of thin air. They have a history. They trace their roots back to the ancient civilizations, where they were used as a form of risk management for lenders. Imagine being in ancient Mesopotamia, where grain loans to farmers were repaid with interest at the time of harvest. This was a way for lenders to compensate for the risk they took. If the harvest was bad, they might not get their grain back, let alone make a profit. The interest was a safety net, a way to ensure that lending wasn't a losing proposition. In many ways, the concept of interest rates hasn't changed much since those ancient times. It's still a tool used by lenders to manage risk. But the application and calculation of interest rates have evolved significantly. Interest rates have been around for a long time, and they've evolved significantly throughout history. Did you know there's more than one type of interest rate? Indeed, when it comes to borrowing money, the type of interest rate attached to the loan can significantly affect how much you end up paying back. Let's dive into the three main types of interest rates: fixed, variable, and compound. First off, we have fixed interest rates. As the name suggests, these rates remain the same throughout the life of the loan. No matter what happens in the financial market, your interest rate will stay consistent. This can be beneficial for budgeting, as you'll know exactly what your repayment will be every month. On the other hand, we have variable interest rates. These rates are tied to an index interest rate and can fluctuate over time. If the index rate goes up, so does your interest rate and consequently your loan repayment. But if the index rate drops, you'll pay less. This type of interest rate can be a gamble, as it introduces an element of uncertainty. Then there's the compound interest rate. This is a little more complex. Compound interest is calculated on the initial principal, which includes all of the accumulated interest of previous periods of a deposit or loan. Think of it as interest on interest. It can cause a loan amount to grow at a faster rate compared to simple interest, which is calculated only on the principal amount. Each of these types of interest rates has its own advantages and disadvantages, and the best one for you depends on your financial circumstances and risk tolerance. For instance, if you prefer stability and predictability, a fixed interest rate might be your best bet. But if you're willing to take a risk for the possibility of paying less interest over time, a variable rate could be worth considering. Knowing the different types of interest rates can help you make informed decisions when borrowing money. It's crucial to understand how each one works, so you can choose the right loan for your needs and budget. Remember, knowledge is power, especially when it comes to your finances. Ever wonder why interest rates go up and down? Well, it's not just a matter of chance. There are several key factors that have a direct impact on interest rates. Let's dive into some of the most influential ones. First off, inflation. Inflation is the rate at which the general level of prices for goods and services is rising. When inflation is high, interest rates tend to rise as well. This is because lenders want to ensure that the return on their investment will not be eroded by inflation. They need to cover their risk of losing purchasing power over the period of the loan. Next up, economic growth. If an economy is growing rapidly, demand for credit is likely to be strong. This can put upward pressure on interest rates. Conversely, in times of economic downturn, there may be less demand for credit, which can lead to lower interest rates. Then we have the central bank policy. Central banks, like the Federal Reserve in the United States, use interest rates as a tool to manage economic growth and inflation. If the economy is overheating, they might raise interest rates to cool things down. On the other hand, if the economy is struggling, they might lower interest rates to stimulate growth. Government debt can also have an effect. If a government borrows heavily, it may have to offer higher interest rates to attract investors. This can push up interest rates more broadly. And finally, international factors can play a role. For example, if interest rates are higher in other countries, investors may decide to invest there instead, leading to a rise in domestic interest rates to compete. As you can see, interest rates are influenced by a complex interplay of factors. They're not just numbers plucked out of thin air. They're a reflection of the economic landscape at a given time. Understanding the factors that influence interest rates can help you anticipate changes and plan accordingly. Interest rates don't just affect your wallet, they impact the entire economy. You see, interest rates act like the thermostat of an economy. Just as a thermostat regulates the temperature in a room to keep it comfortable, interest rates regulate the pace of an economy to keep it balanced. Let's consider high interest rates. When interest rates are high, borrowing becomes more expensive. Imagine wanting to buy a house, but the interest on your mortgage is sky high. You'd likely postpone your purchase, wouldn't you? This is exactly what happens on a larger scale. High interest rates discourage people and businesses from borrowing and investing, slowing down economic activity. Now, this may sound negative, but high interest rates aren't always bad. Sometimes they're necessary to cool down an overheating economy. If people are borrowing and spending too much, it can lead to inflation, where the prices of goods and services rise rapidly. High interest rates can help slow down spending and keep inflation in check. On the other hand, low interest rates can stimulate economic growth. When interest rates are low, borrowing is cheaper. That house you've been eyeing, with a low-interest mortgage, it suddenly becomes more affordable. This encourages people to borrow and spend more, fueling economic growth. The same goes for businesses. Low interest rates make it cheaper for them to borrow and invest in new projects, creating jobs and boosting the economy. But just like a thermostat set too low can make a room uncomfortably cold, interest rates that are too low for too long can lead to problems. It can cause a bubble, where prices rise rapidly and unsustainably, only to crash later. So, you see, interest rates are more than just numbers. They're powerful tools that central banks use to regulate the economy. They can encourage or discourage borrowing and spending, stimulate growth or curb inflation, create jobs or prevent bubbles. And that is why interest rates play a crucial role in the health and growth of our economy. Understanding interest rates is more than just financial jargon. It's like having a secret key to a treasure chest of financial wisdom. It's about being in control of your money, knowing where it goes and how it grows. When we delve into the world of interest rates, we're not just talking about percentages and decimals. We're talking about your hard-earned money, your dreams of owning a home, your plans for a comfortable retirement, your children's education, and even your day-to-day budgeting. Interest rates can shape our financial decisions, encouraging us to save more, spend wisely, or invest strategically. They're the heartbeat of the economy, pulsing in the background of our financial lives. By understanding interest rates, we equip ourselves with the knowledge to make informed decisions, to navigate the financial landscape, and to ultimately secure our financial future. So, next time you hear about interest rates, you'll know exactly what they're talking about and how it affects you. If you enjoyed this video, don't forget to like and subscribe to our channel. Thanks for watching.